One thing to keep in mind is that a lot of people, no matter what the situation is, we have a tendency to fight the last battle. So say we lost a sports game, we focus on, whatever mistake we did. That's what we're focusing on, worrying about happening again. Same thing when we have a recession. People always assume that the next recession is going to look like the past recession. And so what happened in the past recession, the 2008, 2009 crisis, and then the aftermath, was that we had, like as you pointed out, central bank assets were a very small percentage of GDP prior to then, and banks were highly leveraged. And so what happened was when the private sector debt bubble blew up, so real estate values went down, all these banks were highly leveraged, they had very little cash reserves, so they pretty much went insolvent. And so the Federal Reserve and the Treasury came in and said, okay, we're going to buy some of these toxic assets from you. We're also going to buy some of the treasuries from you. Basically, we're going to create new base money or Chuck E. Cheese tokens, as you pointed out. We gave them to the banks and then took some of their assets in return. So the Fed, they took something in return for those assets. Some of those things were worth money, like treasuries and mortgage-backed securities. Other things ended up being toxic and then kind of basically filtered through and kind of removed from the private sector. And so, however, that didn't get out into the broad money supply. That mainly just stayed in the banking system to recapitalize the banks and to help them be more solvent, essentially. And so, if you looked at broad money supply, it didn't really do much at all from that that 2008 to 2015 period where they were increasing those bank reserves for that first leg up. It's because if you were a homeowner and you lost your job and you couldn't pay your mortgage, you lost your house. You didn't get bailed out. There were minor fiscal programs like cash for clunkers or things like that. There were, around the margins, there were these fiscal stabilizers, but there wasn't some sort of big kind of public bailout. It was mainly to shore up the financial system. And so some people got bailed out. Most people didn't. Most people on Main Street didn't. And so we didn't have that big increase in broad money supply. So bank reserves are things that, the banks, they hold it with the Fed. And so it's an asset for the bank, but it's a liability for the Fed. Then the banks, when we have money, like when you or I have money, we store, if we store it at the bank, that's the bank's liability and our asset. And so that's the part of broad money. And so what made this 2020 to 2021 period somewhat different then is that broad money supply actually did go up quite a bit. And that's because unlike the 2008, 2009, all the way up through, the years after period, this time they actually did send a lot of money to people. So they sent people stimulus checks. If you lost a job and you weren't getting your income, they would send you $400 a week in extra federal unemployment benefits on top of the state benefits. And so, for some people got literally, thousands and thousands and thousands of dollars of stimulus. Then you had, the PPP loans that mostly turned into grants. So basically these small business loans that were then forgiven in large part. Then you had corporate, grants essentially. I mean, they weren't loans for the most part. They were given. And so what that did was that actually increased the broad money supply, because the way that the mechanism there works is the Treasury sent people money out. They're like, you get a car, everybody gets a car. Then they issue bonds to pay for that. But then instead of the private sector buying those bonds and that draining cash from the system, the Federal Reserve creates new base money and buys those bonds. And so the way that it gets into the broad money supply and out of the Chuck E. Cheese area is that fiscal component where they literally send you the check. And so that's kind of how the 2020/2021 period has been somewhat different than that other period, and why broad money supply has gone up very quickly. Now there are still some issues, like for most of the past year, people had limiters on how much they could spend that money, right? So people were mostly skipping their vacations. They were driving less, and they were mostly staying at home and basically being far more efficient with how they did things, and they invested in like a second Netflix subscription, or they bought Disney Plus or something, rather than go on like a trip to Europe or traveling around. And so that the things they spend money on were not the more inflationary sort. So energy prices were low, all sorts of things were low. The concern to look out for now is that people's bank accounts are largely stuffed with cash, and things are opening up, and we're heading into the summer, and we have these easy base effects. So now we're in the period where some of that inflation might actually start to be more apparent, is how I'm looking at it. And that's whether if a banking system fails, you can have bailouts or bail-ins, or neither. And so if you go all the way back in the United States to we were already talking about the 1940s. Let's go back a little bit further to the 20s and 30s. When they had that big crash in 1929, then they went into the Great Depression. Uh, you know, uh, Banks failed. There was no FDIC insurance. So if your bank failed and you were a depositor, you lost your money. And because of that, we had this big debt bubble collapse. About a third of banks just went out of business, and about a third of the broad money supply just disappeared. And so people literally had checking accounts, and then those just vanished, or they got a haircut. They got cut in half and said, this is we're insolvent now. We can only pay half the deposit back. And of course, that was deflationary. If people have less money, and it generally pushed down the prices of a lot of goods. And then only years later, as you got into the early to mid 30s, they started to do things to kind of unwind that deflationary spiral, where they devalued the dollar versus gold, which helped some banks stabilize because they had gold as reserves. They basically did a bunch of things to kind of recapitalize the banking system, and then you started to get that inflationary move out of that deflationary collapse. And so that's an example of no bailout came, at least not right away, and so people actually lost their money in their banks. Now, if you fast forward to 2007, 2008, 2009, in the United States, when we had that big collapse of the banking system, depositors were still safe, because instead of letting that happen, they we did the whole, like we talked about before, we made more of those Chuck E. Cheese tokens. And so anyone who was invested in a bank that the bank had an issue, they were still covered as a depositor. And so we did not have a decrease in the broad money supply. We didn't have a spike either, for reasons I described before. We kind of just had broad money kind of kept doing its thing during that period. We didn't really get a spike in money supply until these past couple years. And so that's why we had two very different scenarios. Now then, if you take that same question, you look at Cyprus. Now the difference that a country like Cyprus has is that they adopted the euro, and so they can't, that country cannot print their own currency. Same thing for Greece, same thing for Spain. These countries no longer have the power to print their own currency. They can't decide how many Chuck E. Cheese tokens are in their banking system. They basically outsource that to the broader European system, which of they're only a small part. And so if their banking system collapses, they can't say, okay, we're going to print a ton of money, we're going to make sure every depositor is made whole, we're going to make sure that they can't, they literally don't have the capacity to do that. It's not even a choice, unless they were to break out of the whole European Union and kind of reformat their whole banking system. So within the current construct of where they were, they literally didn't have the money. So they went out and they said, hey, can we get a bailout? And then they if they're denied, well, then their only option is they say, okay, so if we're going to do a bail-in instead. So if you're a depositor in that bank, they say, okay, everybody gets a haircut on their deposit. If you're a big depositor, you get a bigger haircut as a percentage. And if you're a bank bondholder, you get a haircut. And they gave people bank equity in exchange for their haircut. And so they said, okay, you'll lose some of your cash, but now you own more of this halfway insolvent bank now. So congrats on that. And so you actually you lost money. And so the main thing there, kind of judging whether or not that's likely in any given country, is that country monetary sovereign? Because a monetary sovereign country is able to effectively inflate their way out of it, in the sense where bondholders can still get screwed over by having their bonds failing to keep up with inflation. Same thing for cash holders, right? So you can still lose value on your deposits, but it's for a different reason. Instead of actually losing the number of units in the system, they can spread it out and mix it up so that the individual units are worth less, but you still have just as many of them. Whereas in those countries that cannot, they literally can't print money because they've joined a union, and they basically outsourced their printing, they outsource their printer, then they have to resort to things like bail-ins. You see a similar thing in emerging markets when they have dollar-denominated debts. And so they can't simply print dollars. Like Brazil can't print dollars, or Turkey can't print dollars. And so if they have insolvencies related to an outside currency that they can't print, then there's actual risk of nominal default and localized collapses there, because it's liabilities that they can't print. And so that's kind of the way to watch that and kind of judge the different probabilities of different outcomes. And there's you can lose deposits by bail-ins, or you can lose deposits by just having them failing to keep up with inflation. And so, for example, if you look in the United States over the past 10 years, even with the the low interest rates that you've got on your bank deposits, you haven't kept up with the official CPI, let alone what your personal inflation basket might have actually been.